What has caused this tremendous sell-off? Is it because of supply? Is it because inflation and or growth was higher than expected?
Well, I think when you think about the long bond, let's say 10-year bonds, it's really a combination of two different pieces, which is the impact of changes in expectations of monetary policy. And we've gone through a few waves of this where, the expectation has been repeatedly that the Fed would quickly shift to cuts, and that has not turned out to be the case. And we've sort of been in the last unwinding of that expectation for this last bond up move. And remember, when it comes to the volatility of bonds, a fair amount of that volatility happens in the pricing of Fed expectations over the course of the next couple of years. So that sort of recognition of the Fed policy that's higher for longer drove it. And then, of course, there's the additional impact of the supply issues, which Mike has discussed, where we've had the long end was reasonably suppressed because there wasn't a lot of bond supply, both from the government related to the debt ceiling issue and then the filling of the TGA using bills, really for the last 9 months or so, plus relatively subdued corporate supply in addition. And so, with a little bit of thawing of the corporate markets and the government now needing to issue longer duration to finance the relatively sizable deficits, that's starting to impact the long end and create a repricing there. So I'd emphasize basically both of those issues are in some ways behind us rather than ahead of us, given that we've had, most of the cuts expected by the Fed have been priced out for this most recent, move upward in yields in the near term. And then also the duration supply, the increase in duration supply is mostly happening now, and I think is meaningfully influence the existing price. But on a forward-looking basis, the dynamics of the bond market and the complexion of it are going to be a little different than what we've seen over the last couple of months.